Thank you, everyone. When Brad asked me to speak, I didn't realize I was getting the 9:30 slot, so I'll try to keep it moving and wake everyone up here. Let me make sure I have this. So first, I wanted to set the landscape as we talk about global capital flows with a particular focus in the U.S. Of course, the broader markets are trading off historic highs with significant volatility around rates after a real bullish move following the tax cut in the U.S. That said, REITs have traded off even more significantly and traded off even before that volatility, so north of 10% with a slight recovery. The debt markets remain very constructive despite the fact that the 10-year is threatening 3% in the U.S. as the Fed moves up short-term rates. And all lenders are active, including the securitization market, which is very important with respect to larger transactions. All that said, real estate activity has moderated since 2015. We're off 7% in total transaction volume, 16 to 17. And a lot is changing in the real estate world in the U.S., with industrial logistics benefiting from e-commerce, while retail is suffering somewhat. And all things residential very much in favor, whether that's multifamily, senior housing, student housing, etc. Importantly, the longer-term trends continue to support U.S. real estate. So what do we mean by that? Institutions continue to allocate towards real estate and real assets. They remain underdeployed to real estate. Global capital continues to look out of country. And importantly, high net worth is now following institutions in large scale into real estate. As we look at a few key statistics in the marketplace, pointing out a few things, 10-year in the high twos, threatening once again 3%. That's a major factor with the U.S. markets. I'd point to the high-yield bond market. You see 6% there, not particularly high yielding. And when you think about real estate as an asset class and the returns you can achieve on a core, moderately levered investment in real estate, it compares very favorable with high yield, one of the dynamics that's driving the market. Importantly, we're off significantly, as I said, in the broader markets. And if you look at that premium or discount to NAV in U.S. REITs, it's significant, 7%. We haven't seen much activity in IPO markets in the U.S. As we move to rates very quickly before we get to global capital, despite the uptick in rates, you can see we're at historic lows as you look back to 93. And the environment's still very constructive in terms of investment in hard assets. If you look at the upper right-hand part of the screen, you'll also see as we look out to 2019, unemployment and inflation remain favorable. As we compare the REIT market as a harbinger of the private real estate market to the broader markets, once again, you'll see around 10%. Compared to the S&P, down slightly. And then importantly, on the bottom of the screen, you'll see the REIT market trading significantly below NAV and having been below NAV since 2013, once again, suppressing public activity. As we move to the private markets, you'll see cap rates across asset class continuing a march downward. These are average institutional cap rates. And so the product that you're more likely purchasing would be inside of this on a cap rate basis. But once again, moving from the recovery in 09 to 17, steadily down from high single digits to mid single digits on an average basis. And then as we turn to transaction volume, you'll see once again a steady increase in volume from 08, 09 bottoms all the way up to 2014, where we've seen a plateauing activity. In this chart, you'll see the dark green is individual asset activity, which has remained relatively steady 14, 15, 16, and 17. Where we've seen the volatility is in portfolio and entity transactions, particularly entity transactions, which tend to move more with broader markets. And now we come to cross-border investment into the U.S. And once again, you'll see a steady march of increased cross-border investment. One thing I'd point out here, you see a relatively equal play between the various colors on this graph: office, industrial, retail, multifamily, hospitality, et cetera. And so we're seeing global capital come into the U.S. in multiple asset classes. If we were talking about this 10 or 15 years ago, that may not be the case. We would be talking more about CBD markets and large office transactions. Particularly notable is the light green and the red on the screen, the industrial and multifamily, which of course have become favorite sectors within the U.S., given some of the trends, and also attracting significant global capital. As we look more recently just to Q4 data, you can see on this chart, only cross-border capital in Q4 2017 was a net buyer of U.S. real estate. So very, very notable. And if you look at the volumes, cross-border at 12%, in excess of the U.S. public REIT market, very significant. The overall market down slightly, but cross-border activity noticeably significant. And then as we look back a little further over the last 3 or 4 years, a couple things jump out of this slide, which I particularly like the analysis. You see that public companies in the U.S. have been net sellers, as have private companies. Private equity, which has been accumulating a tremendous amount of capital over the last few years, has been relatively neutral. So the buying demand has come from domestic institutions, but even more notably from global capital or foreign institutions, as it's labeled here, almost negligible in terms of selling activity from those names, and significant share of buying activity. And here we look at a map just in terms of overall transaction activity, with the U.S. almost 30% of the world. One thing that I'd point out here is we're seeing increasing connectivity between global markets. So as we know, capital out of Asia has become a little more difficult with capital controls. We've seen that capital flowing into Hong Kong. As Hong Kong has received considerable liquidity, we've seen Hong Kong money flowing into London. And so those markets continue to be even more connected today than they were certainly 5, 10, 15 years ago. As we look at overall global capital into the U.S., we see a variety of regions represented with large capital flows. Canada certainly has always been a major player into the U.S. markets. Europe, notably, continues to be a major player into U.S. markets. And Asia, most recently, particularly with Chinese capital still playing a large role, the most significant input into U.S. markets. If I had this page, which we often use in pitch materials, showing individual countries with investor names under those countries, what you'd see is many more countries today than you did 10 years ago, and many more names under each of those countries. So it's both breadth and depth of capital that we've seen over the last cycle coming into U.S. real estate markets. As we look at particular markets for global capital in the U.S., we still see the major gateways at the top: New York, D.C., San Francisco. That said, if you look at the percentage changes, you'll notice something interesting. Houston stands out as a major aggregator of global capital, as does D.C. Metro to the positive. These are both, to varying degrees, recovery plays. D.C. had been out of favor as the government spending had decreased a few years back. And Houston, of course, with the drop in oil prices, had been very much out of favor in almost all property sectors. And now with the recovery in oil prices, we've seen capital come back to it. Notable that global capital is playing with the same sophistication as U.S. capital in these markets, and not just gravitating towards the major metros more broadly. And here we look at institutions generally. As I pointed out, institutions continue to allocate to real estate, but they remain underdeployed. They've crossed the 10% barrier in terms of allocation, but still 20 basis points expected underdeployment versus their stated goals. About 5 years ago, When I first joined CBRE, we had a head of asset management of one of the major firms speak at our conference. And he told a story that as they looked at their allocation, as they moved away from fixed income, given the concern over the increase in rates, and they allocated to real assets, they could both increase their alpha and decrease their beta, and overall on their portfolio receive an aggregate return of 150 bips better than their prior allocation. That rationale still holds true, and that is why we're seeing institutions allocate to real estate. We think that's not a 5-year trend. We're probably 5 years into this trend. It's probably a 20-year trend. And then lastly, as we look at the rationale for global capital into U.S. real estate coming out of the AFIRE survey, we see a few things: diversification out of country and currency, risk-adjusted returns to the positive, a stable and secure investing environment, and a desire for yield. We're seeing this in a variety of ways. We're certainly still seeing it in fund investments, particularly the larger fund aggregators, which have been winners in this post-recession cycle. We're certainly seeing it in separate accounts, but importantly, we're seeing it also in direct investments, which is a major theme that differentiates this cycle from prior, seeing global capital coming into direct investments with private U.S. sponsors.